Every generation inherits a myth, not written in law, not carved in stone, but repeated so often it starts to feel like oxygen. You are free. Free to choose your career. Free to buy a home. Free to build a life that belongs to you. But here is the detail that changes everything. In the modern world, choice has a credit limit. Your home is not really yours the way people mean it when they say the word own. It is collateral with a roof. Your education is not a ladder. It is a contract with an interest rate attached. Your car, your phone, your future holidays, even your emergency fund, they are not simply things you buy. They are time you borrow from your future self. And the most unsettling part is this. None of it requires a conspiracy. There is no shadow counsel in a dark room. There is only a system that works exactly as designed, quietly, legally, relentlessly. A signature, a number, a promise. Because in the 20th century, the world discovered something more powerful than armies and more persuasive than kings. Money could be created through debt. Not by digging gold from the ground, not by printing paper, but by typing a loan into existence. A bank does not need to hand you someone else's savings to lend to you. It can create new money with the act of lending itself. Your debt becomes its asset. Your promise becomes its profit. And once you see that, you begin to realize you were never merely living inside an economy. You were born inside a balance sheet. That is what makes this empire so hard to see. It has no flag, no borders, no anthem. It does not march. It does not bleed. It expands in silence, through contracts and compound interest. It rules by arithmetic, not ideology. And it does not need to conquer you. It only needs to seduce you. It whispers that debt is normal, that debt is modern, that debt is the engine of progress. It offers you the future now, in exchange for your obedience later. And most of the time, it feels like freedom, right up until you realize your calendar is not yours either, because the debt clock never stops ticking. This is the empire of debt. And the story we are about to tell is not about a crash that arrives with sirens and headlines. It is about something more dangerous. A silent collapse that repeats through history, not when money runs out, but when belief does. To understand how the empire of debt truly took shape, we have to strip money of its mythology and look at its mechanics. Not how people talk about money, but how it is actually created. For most of human history, money was constrained by something physical. Gold had to be mined. Silver had to be minted. Even paper money was once a receipt, a claim on something tangible held somewhere else. That limitation mattered because it anchored trust to reality. The 20th century broke that anchor. Modern money is not created when governments print bills. That is the illusion most people are taught to believe. In reality, the vast majority of money enters the system when banks issue loans. Mortgages, corporate credit, government bonds, student debt. Each loan expands the money supply. Each repayment contracts it. The system breathes through borrowing. This means something deeply counterintuitive. Money is not a thing. It is a relationship. A promise that someone will pay later. And the moment that promise is recorded, new purchasing power appears. This architecture accelerated dramatically after World War II. Nations were devastated. Infrastructure was destroyed. Governments needed growth, stability, and political calm. Credit became the fastest solution. Bretton Woods stabilized currencies. Central banks coordinated policy. Commercial banks scaled lending to unprecedented levels. At first, it felt miraculous. Credit rebuilt cities. It fueled industry. It lifted living standards. Debt was not a burden. It was oxygen. But every system carries within it the seeds of its own excess. As decades passed, borrowing stopped being a bridge to production and became a substitute for it. Growth no longer depended on making more, but on leveraging more. Wages flattened. Productivity slowed. Credit quietly filled the gap. Then came the turning point, when the link between money and discipline finally snapped. In the 1980s, deregulation transformed finance from a utility into a weapon. Constraints were removed. Leverage was celebrated. Risk was no longer something to be avoided. It was something to be engineered, sliced, repackaged, and sold. Money stopped representing work. It started multiplying itself. Corporations discovered they could grow earnings without growing value. Governments learned they could postpone pain indefinitely. Households were taught that borrowing was not a warning sign, but a marker of success. And slowly, invisibly, Debt stopped being a tool within the economy. It became the economy. By the time most people noticed, the architecture was already complete. A system where stability required ever-increasing debt. Where repayment was less important than rollover. Where confidence mattered more than solvency. This is the hidden structure of the empire. Not evil by intent. Not chaotic by accident. But fragile by design. Because when money is built on promises instead of production, the system can only survive as long as everyone believes the promises will be kept. And belief, unlike gold, cannot be mined. Every system reveals its true purpose by looking at who it rewards. The empire of debt is no different. It does not distribute benefits evenly, and it never has. Its incentives point upward, toward those who sit closest to money creation and furthest from repayment. At the center are the institutions that can borrow at the lowest cost and roll debt indefinitely. Governments, major banks, and large corporations operate in a different financial universe than ordinary citizens. When they borrow, they are not constrained by income in the way households are. They are constrained by credibility. As long as markets believe they will be supported, rescued, or refinanced, the flow continues. Central banks sit at the hinge of this structure. Officially, they exist to stabilize prices and protect employment. In practice, they stabilize the debt system itself. When markets wobble, liquidity appears. When asset prices fall too fast, interest rates drop. When losses threaten systemic players, balance sheets expand. This is not corruption. It is incentive. A system built on leverage cannot tolerate widespread deleveraging. Corporations learned this lesson faster than anyone else. Innovation became optional. Financial engineering became essential. Instead of building factories, firms borrowed cheaply to buy back their own shares. Stock prices rose. Executives were rewarded. Debt increased. Risk was pushed forward in time. For investors with access to leverage, the system was extraordinary. Asset prices inflated. Real estate climbed. Stocks decoupled from wages. Those who already owned assets watched their paper wealth multiply. Those who did not were told to borrow in order to participate. Households were drawn in last. Mortgages replaced ownership. Student loans replaced opportunity. Credit scores replaced trust. A person's future earning power became collateral before it was even earned. Debt did not feel like coercion. It felt like inclusion. And that is the most effective feature of the empire. It does not rule through force. It rules through incentives that make participation feel voluntary. Everyone is offered the same promise. Borrow now, enjoy now, pay later. But later is not evenly distributed. When crises arrive, the pattern is always the same. Losses are absorbed at the bottom. Inflation erodes savings. Wages lag prices. Taxes rise quietly. Meanwhile, institutions with scale and political proximity are protected. They refinance. They restructure. They survive. This is why the system persists even after failure. Because the people with the power to change it benefit from its continuation. And those who bear the cost are too fragmented, too indebted, or too busy servicing yesterday's promises to resist. The empire of debt does not need villains. It only needs aligned incentives, and once those incentives lock in, reform becomes almost impossible without crisis. Which brings us to the moment when the machine finally breaks down. Not from greed alone, but from mathematical limits. That moment arrived in 2008. By the time the global financial crisis arrived in 2008, the empire of debt was no longer expanding through production. It was expanding through belief. Belief that housing prices would always rise. Belief that risk could be mathematically neutralized. Belief that debt could be sliced so thin it would disappear. Wall Street perfected the illusion. Mortgages were no longer simple loans between a borrower and a bank. They were raw material. Thousands of individual debts were bundled together, rated, insured, and sold across the world. Risk was not removed. It was disguised. No one needed to understand the borrower anymore. They only needed to trust the model. The system worked as long as one condition held. Prices could not fall everywhere at the same time. When that condition failed, the machine seized instantly. Defaults spread. Balance sheets imploded. Institutions that were supposedly diversified discovered they were all holding the same promises. Interbank lending froze because no one trusted anyone else's numbers. Money, which had felt abundant, vanished overnight. This was not a liquidity problem. It was a confidence collapse. And here is the critical moment where the empire revealed its true priority. Governments faced a choice. Allow the system to purge itself, forcing losses onto those who created the risk, or intervene, preserving the structure at the cost of public trust. They chose preservation. Trillions were created to stabilize banks, markets, and sovereign debt. Interest rates were pushed toward zero. Central bank balance sheets exploded. The language was technical, but the message was simple. The system would not be allowed to fail. For citizens, the lesson was different. Homes were lost. Jobs disappeared. Savings evaporated. A generation learned that discipline was personal, but rescue was institutional. Profits remained private. Losses became collective. This was not the end of the empire of debt. It was its transformation. After 2008, debt did not retreat. It metastasized. Low interest rates made borrowing painless. Asset prices surged again. Governments normalized deficits. Corporations doubled down on leverage. The system learned that consequences could be postponed indefinitely. Stability returned, but it was synthetic. Growth resumed, but it was thinner. Every year required more debt to produce the same economic effect. The machine ran hotter and faster, not because it was healthy, but because slowing down had become impossible. This is the hidden danger of crisis management through money creation. Each intervention saves the present by mortgaging the future. Each rescue tightens the dependency, and each delay makes the eventual reckoning larger. The empire survived 2008 by teaching the world a dangerous rule. Debt would always be answered with more debt. That rule held, right up until the next shock arrived. After 2008, debt stopped being just an economic tool. It became a geopolitical weapon. What had once been a domestic mechanism for growth and stabilization expanded outward, shaping alliances, rivalries, and global power itself. Low interest rates did not remain a technical policy choice. They became the foundation of international strategy. Countries that could borrow cheaply gained freedom of action. Countries that could not became dependent. Sovereign debt turned into leverage, not only over markets, but over governments. The dominance of the dollar amplified this dynamic. Because global trade, energy, and finance were priced in a single currency, the United States gained a unique privilege. It could borrow in its own money without facing the same constraints as others. Deficits were not a warning sign. They were absorbed by global demand for safety. U.S. debt became the collateral of the world. For decades, this arrangement felt stable. Nations accumulated reserves. Central banks recycled trade surpluses into government bonds. The system reinforced itself. Debt flowed outward. Confidence flowed back in. But stability came with a cost. Financial sanctions replaced military force. Access to payment systems became a form of control. When countries fell out of alignment, their assets could be frozen, their trade disrupted, their currencies attacked. Debt infrastructure became enforcement infrastructure. This pushed rivals to adapt. New payment systems emerged. Bilateral trade bypassed traditional channels. Gold reserves increased. Alternatives were explored, not because they were efficient, but because dependence had become dangerous. At the same time, domestic debt pressures intensified. Governments used borrowing to smooth over political limits. Promises multiplied faster than productivity. Social stability was purchased on credit. Every unresolved structural problem was deferred into the future with another issuance. Then came 2020. A global shutdown forced the system to reveal its true operating principle. When production stopped, debt did not pause. It accelerated. Trillions were created in months. Support programs, stimulus checks, emergency lending. The response worked, in the narrow sense that markets recovered, but the deeper effect was irreversible. Debt was no longer treated as a risk to be managed. It was treated as a solution to every crisis. Inflation followed, not immediately, but inevitably. And when prices rose across the world, governments discovered the limits of their narrative. They blamed supply chains, conflicts, weather, anything external. But the truth was structural. Years of borrowed stability had finally surfaced in the cost of living. This is where geopolitics and debt fully converge. Inflation erodes domestic trust. Sanctions fragment global trade. Rival blocs harden. Monetary policy becomes diplomacy by other means. The empire of debt no longer governs quietly. It shapes conflicts, alliances, and the balance of power itself. And when systems reach this stage, history suggests they are approaching a breaking point. Every debt system eventually collides with reality. Not because it is immoral, but because it is mathematical. Obligations that grow faster than the productive base beneath them cannot be sustained forever. The only question is how the adjustment happens, and who absorbs the cost. The empire of debt is now approaching that boundary. One path is gradual erosion. Inflation becomes permanent rather than temporary. Purchasing power declines quietly year after year. Regulations multiply. Taxes rise without being named as such. Debt is restructured slowly, through policy, accounting changes, and financial repression. Wealth does not vanish, it concentrates. The system survives, but at the cost of a hollowed middle class and shrinking trust. This path feels calm on the surface. Markets continue to function. Institutions remain intact. But beneath it, society adjusts to lower expectations. Ownership becomes rarer. Stability becomes conditional. Freedom narrows, without a single dramatic moment. The second path is digital control. Central bank digital currencies promise efficiency, speed, and stability. But their deeper function is governance. When money becomes programmable, limits can be enforced instantly. Access can be restricted. Incentives can be coded. Debt becomes data, and data becomes power. In this model, the empire does not collapse. It upgrades. Old promises are reset under new rules. Privacy erodes. Autonomy weakens. Compliance replaces consent. Stability is preserved, but choice becomes conditional. The third path is the most disruptive. A return to reality. When trust fractures beyond repair, people seek value outside the system. Tangible assets, decentralized networks, local production, alternative stores of value. This path is volatile and uneven, but it transfers power away from centralized balance sheets toward those who can create, build, and adapt. History shows that none of these paths arrive cleanly. Elements of all three tend to coexist. What matters is not prediction, but positioning. Because when debt grows too large to honor, systems do not fail politely. They rewrite the rules. The illusion that debt can expand forever, without consequence, is already breaking. Inflation exposed it. Rising rates exposed it. Political instability exposed it. What remains is a system searching for a way to preserve itself without restoring trust. And trust, once fractured, does not respond to policy announcements. It responds to truth. Every financial empire ends the same way. Not with empty vaults, but with empty faith. The moment people stop believing that the numbers represent something real, the structure loses its gravity. Accounts still show balances. Markets still open. Contracts still exist. But the shared agreement that gives them meaning quietly dissolves. That is the final vulnerability of the empire of debt. For all its complexity, all its algorithms and institutions, it rests on trust. Trust that tomorrow will resemble today. Trust that promises can be rolled forward indefinitely. Trust that the system will always find a buyer for the next bond, the next rescue, the next delay. When inflation surged, that trust cracked. Not in theory, but in daily life. People felt it in groceries, rent, energy, education. The empire became visible because its cost could no longer be ignored. And visibility is dangerous for any system built on abstraction. History is clear on what happens next. Power shifts, not suddenly, but decisively. From those who rely on paper claims, to those who understand value. From those who wait for permission to those who build regardless of policy. From borrowers trapped in compounding, promises to producers anchored in reality. Debt does not build civilizations. Discipline does. Production does. Trust earned through output, not leverage. When societies replace creation with borrowing, their future is already spoken for. Not by fate, but by arithmetic. The most unsettling truth is also the simplest. This system did not enslave people by force. It offered convenience instead of ownership, speed instead of patience, credit instead of reality. And people accepted, because it felt easier. It felt modern. It felt safe. until it did not. Every collapse clears the ledger, and every reset rewards clarity. Those who understand how money is created, how debt concentrates power, and how trust is preserved are not surprised when the rules change. They adapt. They position themselves where value cannot be printed, frozen, or diluted away. The empire of debt was never about banks or governments. It was about belief. And belief is breaking. The question now is not whether the system will change. It already is. The question is where you stand when it does. Still, paying interest on the past, or ready to write the rules of what comes next. Because history never ends with collapse. It resets. And those who see the reset coming are always the ones who rise when the dust settles.